This is FRM Part 1, Book 1, Foundations of Risk Management, and the chapter on how do firms manage financial risk. Now, a good financial risk manager is going to have the skills to be able to identify the risks, quantify the risks, and manage the risks. I'm going to repeat that many times over in these videos. So let's go ahead and look at the learning objectives for this particular chapter. So after completing this reading, you ought to be able to evaluate the advantages and disadvantages of hedging. You ought to be able to identify and apply the appropriate methods to hedge different kinds of risks. You ought to be able to explain how a company can determine whether to hedge certain factors, and then including the role of the board of directors in that process. And then, of course, when the process is over, you need to be able to assess the value and the impact of the risk management process and, of course, the securities or the instruments used to manage that risk. Now, the chapter begins with an interesting little part in which the reader is asked to consider the simple fact that perhaps risk management is not necessary. So these are called theoretical objections to risk management. What we need to do is get a little bit of a history lesson here. Let's go all the way back to 1958. There were these two economists, Franco Modigliani and Merton Miller. They are among the two who are known as the fathers of modern finance. And what they were doing is they were trying to come up with a way to value a business. And what they did is that they developed this really cool model that relied on some really cool calculus. And what they came up with was the following: that the value of a company depends on the quality of its assets. In other words, the ability of the product lines to generate lots and lots of cash flow over extended time periods, and the firm's weighted average cost of capital. So that was pretty much the focus of this paper. But what gets all of the attention is their capital structure irrelevance propositions, in which they said, if you consider a world that doesn't contain things like taxes or transaction costs or bankruptcy costs or agency costs, and we call that the M&M world. If you consider a world in which capital markets are efficient, then there are no opportunities for risk-free or riskless profits. And this capital structure irrelevance said the following. There's a proposition 1 and a proposition 2, and these two guys made the following conclusions: that the right-hand side of a business's balance sheet, in other words, whether the assets are financed with debt or equity, is irrelevant in determining value based on this really small Modigliani and Miller world. All right, so notice what I have on that second bullet point there, that the value of the firm cannot be changed merely by changing the financial transactions. And in the global sense, that meant issuing a bond or issuing a debt in that Modigliani and Miller framework. All right. The implication of that are severe and significant for us as good financial risk managers. According to these guys, then, the risk management is irrelevant to a firm and irrelevant in determining value. Now, lots of people criticized M&M back in 1958 because they said things like, well, we don't live in a world that doesn't have taxes. We have things like transaction costs and bid-ask spreads, and clearly firms declare bankruptcy, and there's this agency conflict between and among all the different parties inside of a business. But Modigliani and Miller said, wait a minute, the important thing is to focus the attention on measuring the quality of the firm's asset and its weighted average cost of capital. And that other stuff is not important in our framework. But when you relax those assumptions, then those other variables like bankruptcy costs and taxes, they become extremely important. Now, of course, M&M won the Nobel Prize in Economic Science for their work, as did William Sharpe, who developed the capital asset pricing model in 1964, among others. And so the next question then is, what does this CAP-M have to say about risk management. So there in that right-hand box up at the top, there's the formula for the capital asset pricing model, in which the return on an individual financial security is equal to a combination of things like the risk-free rate of interest, the return or the expected return on the entire market portfolio, and then beta, which is the level of systematic risk for that particular business. And what William Sharpe said is that shareholders are going to hold well-diversified portfolios, and they are going to eliminate what the academics used to call unsystematic risk, but what practitioners tend to call these days idiosyncratic risks. All right, so the conclusions that William Sharpe and others who developed this capital asset pricing model is that, of course, risk management is important, but only in the context of well-diversified portfolios. So we can manage systematic risk, but what we can do as shareholders, as investors, is virtually eliminate that unsystematic risk component, so that firms don't have to worry about that unsystematic risk component. So firms should alter their activities only to hedge the systematic risk that their shareholders and the entire market faces. By the way, William Sharpe won the Nobel Prize in Economic Science for this work as well. And let me mention the two boxes up at the top. The SML, that's called the security market line. That's just a picture of the capital asset pricing model, which is a special case of the capital market line, which instead of using beta, uses the ratio of two standard deviations as its measure of risk. All right, how about some practical objections to risk management? And these are not very compelling. You know, it's a distraction, it's data intensive, it's costly, and those kind of things. They might be true, but once again, just like I try to teach my children when they make decisions, even as simple as whether or not they want to go to the movies, that you've got to balance the marginal costs with the marginal benefits. And of course, notice what I have in the box down below. These objections slow down profitability and wealth creation. In fact, you know, you might even say that it's wealth destruction if you don't manage risk. All right, so now that we see what the academics and maybe what some practical guidelines are for avoiding risk management, and we probably don't like those very much, let's go ahead and look at some compelling reasons for risk management. The efficient markets hypothesis does not reflect true conditions prevailing in the market. There are things like transaction costs and taxes. Costs of gathering information almost always exist. And then there are arbitrage opportunities, mainly because the price of an asset which trades in different markets is not always the exact same price. Now, the arbitrage opportunities that exist these days tend to be available only to those individuals working in the financial services industry with access to large data sets and large amounts of capital, and to be able to, you know, just press a button and hit an algorithm so that lots of trades can take place. Now, the efficient markets hypothesis, of course, recognizes the simple fact that firms can default, but what it does is that it either disregards or discounts the costs of financial distress and bankruptcy as it relates to the entire market. You know, we call that contagion in the academic world. And the great example is just to go back 10 years ago or so when we had this financial crisis. And what did I say in that very first slide? Identify the risks. Well, back in 2006 and 2007, we did not identify the risks because we were thinking that mortgage and mortgage-backed securities were really, really safe investments. We didn't know how to quantify the risks because the ratings agencies, among others, said that mortgage-backed securities have a AAA rating, and then clearly we didn't quantify those risks. In addition to that, we have this agency conflict, which is kind of a natural battle between the agents of a business, which are the corporate leaders, and then the owners of the business, which are the shareholders. So note, risk management is vital for success. Put an exclamation point after the word success. How about tax incentives? I mean, this is really a cool item. I mean, I'm not an accountant, although I do have an undergraduate accounting degree. I've never really done anyone else's taxes other than my own. I'm lucky. My very, very close friend is one of the leading tax accountants in the area, so he helps me with all my questions. But I do know this, that if you think of an earning stream, and I'll just go ahead and do a little line, if you think of an earning stream that goes straight across, stable and constant earnings, what that means over time is that firm is going to pay pretty much the same marginal tax rate. But if you have volatile earnings that go up and down like this, think about that firm at times is going to pay the highest marginal tax rate. So volatile earnings induce higher taxation. There's no doubt about that. Another really cool thing about risk management is that when firms hedge, what that does, it means that they're probably going to use some kind of an instrument that has the advantages of leverage. And so they're going to hedge, which of course reduces risk, but that increases the ability of the firms to issue traditional debt instruments like a bond or a note. And this will increase the interest tax deduction. And then, of course, there's this whole area of derivative securities, which is prevalent throughout risk management, and firms can use derivatives for tax avoidance. And this can occur multiple times, but a simple example is just consider a firm in which it uses a contract, maybe a futures contract, or maybe an option contract, and what that's going to do is that's going to reduce some kind of risk. Maybe it's an input price, maybe it's some kind of an output. But what that tends to do is that it lowers the tax liability. All right, how about operations versus financial position? So a firm can choose to hedge against volatilities related to its operations. It may hedge the cost of input materials. And so what that enables a firm to do is concentrate on its core business. Here's the example that I always give my students. I mean, let's suppose that you're a large company and you don't have any operations in Iceland. And so you decide that you're going to sell some product in Iceland. So you go over to Iceland, and this project has a positive net present value. So you have the operations or the distribution or whatever it is in Iceland, and you sell your product in Iceland, and you're generating lots and lots of the Icelandic krona in cash flows. Well, no matter how profitable that project is in Iceland, when the firm repatriates those funds back to the United States, assuming this is a US-based company, it may take, let me take an extreme example. The firm may be generating hundreds of thousands of Iceland krona in cash flow, and when it repatriates those back to the United States, they get $100. And so think about the corporate leaders going to the shareholders and saying, look at this great product line over in Iceland. Everybody in Iceland, they love our product line. And so the shareholders are high-fiving everybody, and they'll say, okay, what kind of a dividend payment am I get in terms of US dollars? And the executives say, well, all we got was $100 because the exchange rate moved against us. Isn't that a shame? All right, so that's the idea of hedging against the operations. I mean, it's clear that firm ought to use some kind of a forward contract. But hedging currency exposures, it's going to reduce the risk of losses. Clearly, it's going to reduce the risk of losses. And so there's an example of a tomato ketchup company. And this is exactly what I was talking about. All right, here we go. Let's go back to that efficient markets hypothesis. If the marketplace is perfect, and that means that when marketplaces are perfect, that means buyers and sellers have the same amount of information. They have the same quality of information. They have the same degree of information. And those individuals process the information the same way, which means they arrive at the same conclusion. And so here's the thing. Get back to my Iceland example. The currency moved against that business. Well, if the currency moved in favor of that business, well, that's a completely different story. So if we have perfect information, if we know what direction the currency is going to go, if it's going to move against us, then we'll hedge. If it's going to move in our favor, then we won't hedge. But if everybody knows this information, there's really no need for hedging. It won't alter, it won't change the financial health of the firm. If hedging is attempted, it would be an even swap for both parties because they have equal information about the markets. But of course, markets can be inefficient. And so there are lots and lots of benefits from hedging. We've talked about some of these before: increase of debt capacity, increase of tax advantages. Of course, there are things like economies of scale or having superior information. Now, firms should essentially hedge their operations, and if they hedge their financial position, they should be transparent about their policies. Of course, the corporate leaders are going to hire accountants that are going to come in and evaluate all of these hedging strategies and hedging results, and they're going to report it to the shareholders. And so notice what I have in that box below. Boy, we're going to accept some forms of risk. We're going to hedge other forms. We're going to manage those hedging costs. There's that marginal cost and marginal benefit. And these constitute the core activities of best risk management practices. All right, how about an objective? 2 slides on this one. Clear decisions on pertinent matters are required. Of course, the board of directors, it's their responsibility to establish the strategic plan for a business. Like taking a US-based company and saying, okay, there's a market in Iceland, let's go ahead and pursue that. All right, so there should be clear objectives and clear goals. And the objective would sound something like, we want to generate lots of cash flow in Iceland. And oh, by the way, we're going to be exposed to things like political risk. We're going to be exposed to things like operating risk. We're going to be exposed to things like currency risk. So how can we manage those risks? And so the risk appetite is going to be determined by the board of directors. And remember that it's the board that was elected by the owners of the business. So the board acts in the best interest of the owners and the shareholders of the firm. So it's got to include the type of risk. So what did I say that very first slide? Identify the risk. What did I just say? Political risks and operating risks and currency risk and maybe some other risks as well. We want to limit those losses with confidence levels. Oh my gosh, so this brings in the whole idea that we need to look at distributions of these cash flows and distributions of payoffs so that we can compute some kind of a measure of volatility. Let's call it standard deviation. We can put together confidence intervals. We can do all sorts of fun things so that we can manage that. So the board is going to establish that risk tolerance level and say, oh, you know what? We know we can't exactly predict, so it's not going to be that perfect average, but will the board say, all right, this much of a confidence interval is acceptable, or this much of a confidence interval is acceptable? And it goes back, of course, to whatever the shareholders want. Here's one of my favorite things. Risk-adjusted net present values can be used to screen projects. Of course, when this business goes over to Iceland, what they're going to do is they're going to compute the net present value in terms of US dollars. But then it's going to put this in an Excel spreadsheet and then have a whole Excel spreadsheet with variables under different scenarios and different sensitivity levels. And this compounds the risk levels, but what it does is it identifies the layers and maybe the silos so that the risk managers are better able to identify and quantify and manage those risks. All right, so the board clearly sets objectives, so both the bondholders and the shareholders are going to receive their promised payments. Remember, the bondholders, they receive a promise to receive interest and principal. Shareholders receive a promise to receive maybe dividends if we're successful and maybe capital gains if the business is successful. Time horizon for risk management should also be set by the board. I mean, it doesn't sound right if the board gets together and says, okay, we want to establish these risk management principles forever and ever and ever and ever. I mean, clearly the instruments to hedge risk have maturity dates and expiration dates. And so hedging in general is a short-term issue. However, it's part of the long-term goal of maximizing shareholder wealth. But hedging is a tactical issue that has to be part of the strategic long-term plan. And so, of course, it has implications on tax liabilities and liquidity and all of the stuff that the accountants do in order to record the activities of the business. Now, remember, when we use futures contracts by taking the long or short position, that those things are marked to market on a daily basis if they're trading on an organized exchange. And that has tremendous implications in the accounting of the firm. I love giving movie examples, and one of my favorite all-time movies, are you guys old enough to have seen Trading Places, where Dan Aykroyd and Eddie Murphy, they cause havoc on the New York Mercantile Exchange. And at the end of the day, these two old dudes who lost all their money, they come out and say, turn those machines back on. And the board president comes out and says, our accounts are settled every day. You owe us, what was that number? $376 million or something like that. So the fact that the exchanges have these daily mark-to-market rules, that means that our hedging strategy, our tactical hedging positions have to be monitored on a daily basis. Now, of course, what that means then is that we don't have to pay taxes on this every day, but we'll do this by the end of the year. How about an assessment of the magnitude of risk? So there's a general policy structure pertaining to risk management that's set up by the board, and then the corporate leaders or the officials should identify those risks and record, both on the left-hand and the right-hand side of the balance sheet, which is the exposure, which one's greater, right? Are assets greater than liabilities, liabilities greater than assets, or is this a combination of a cash flow issue? And so, boy, it's really an interesting proposition just to rank these. Then we need to figure out what are the appropriate instruments to hedge your risk, to hedge the risk. I mean, I tell my students all the time, a forward contract is easy and it's relatively cheap and it's relatively simple, but there's probably not a great secondary market for lots of these forward contracts. So then you move to the futures exchange, then you have to worry about daily settlement. And then you think, oh my gosh, an option might be better, but look, forward contracts and futures contracts, they have very little upfront costs, if any. But an option contract has a premium, and this can be very pricey. How about internal hedging? Here's the use of a firm's liabilities and assets to hedge exposures. And so let's take an example of a company like Unilever that manufactures and distributes Q-tips, right? Q-tips, we all use Q-tips. And let's suppose that it imports plastic from Germany and that it imports cotton from India, and it imports those materials to a manufacturing plant in Canada. All right, so think about what this financial statements are going to look like. So we're importing in one currency, importing in yet a different currency, and then we're taking those materials to yet a third country in Canada. So we're using those, and then we're hiring people in Canadian dollars, right? So the wage is going to be in a third currency. And then we sell these Q-tips in the United States, let's say. Oh my gosh, you've got assets and liabilities and revenues and expenses. You got all sorts of stuff in all these different currencies. Well, let's just take the extreme example. What would be the easiest thing in order for hedging would be just for Unilever to set up a manufacturing and distributing facility in Germany and in India, and then send the finished products to the United States and sell it. So that way you have some offsetting positions. Now, of course, those are huge capital expenditures, and so that goes through the whole capital budgeting process. Now, I'm not saying that's the optimal way to provide this with a solution, but you can see in the extreme example what that does is going to assume it's going to make those positions offsetting within the firm, so there's no need to go to an external hedge. Now, the external hedge can occur either in the exchange-traded markets or the over-the-counter market. On the floor of places like the New York Mercantile and the Chicago Mercantile exchanges, the contracts are standardized. So the size of the contract, the exercise prices if it's an option, maturity or expiration periods. Those are all determined by the exchange. For example, a company like Southwest Air, who does lots and lots of hedging because they buy oil every day, right? They got to put gasoline in their airplanes, and so if you take a long or a short position in an oil futures contract, it has to be 1,000 barrels. Over the counter markets, there's a little bit more flexibility, and so Southwest Airlines could go to, let's say, a financial institution like Wells Fargo and say, "Hey, I want a contract for 1,035 barrels." I mean, they probably wouldn't do that. It's such a small amount, but it could get it in the over-the-counter market. But of course, when you go to the over-counter market, there are different ideas. There are different levels of risk. So there's going to be some credit risk, and there might be some liquidity issues and some transaction cost issues as well. Once again, marginal cost versus marginal benefits. And the great financial risk manager knows those marginal costs and marginal benefits for all of these products. All right, how about devising and implementing a strategy? All right, so, of course, in order to be able to identify and quantify and manage, you have to have access to information, and you have to have access to all the relevant data. All right, so access to relevant information, data, and statistical tools. Of course, you need to be able to understand things like standard deviation and value at risk and confidence intervals and all that kind of stuff. And so notice the circle under the first bullet point. Risk management team should have a background knowledge of statistical tools used in hedging. I had a bunch of doctoral level econometrics classes hundreds of years ago when I was back in graduate school. And as painful as it was going through those courses, they really benefited me throughout my life. Now, static strategies are cases in which the business says, all right, we're going to use this contract like a forward contract or an option contract, and then we'll just wait until the end and then see what happens. And sometimes this works. Most of the time it doesn't. What is required because of the changing nature of capital markets and risk levels are dynamic strategies. This requires more managerial effort and probably a sequence of trades. When you study options and options trading strategies and hedging strategies, a lot of times you use that cumulative normal probability density function that you can get out of the Black-Scholes-Merton option pricing model, and you can use that fraction to help you devise a risk-free portfolio. But it's called a dynamic hedging strategy because you got to watch it every second of every day. How about time horizons? We mentioned this before. So there are the hedging positions and then accounting considerations related to the hedge. Of course, if there's the end of the accounting period occurs during the middle of the hedge, then the financial risk manager is going to have to decide, do we want to leave that hedge open or do we want to close it? When do we want to close it? All that kind of good stuff. And this marking to market provides opportunities for perfect hedging, and there are very few opportunities for perfect hedging. But if you're a farmer or you're a baker and you either are supplying or demanding things like corn or wheat, and you can match up the spot market with the futures market, then you can get a perfect hedge. But other than that, it's probably not totally rare, but more rare than an imperfect hedge. So when you have an imperfect hedge, then you're not completely locked into a future value of the underlying asset. And of course, different tax laws in different countries, they can wreak havoc on all of these strategies. And so a good risk manager has support from knowledgeable accountants and tax lawyers who know exactly what's going on in all these other countries. Now, of course, at the end, when we've managed this risk, when businesses have managed the risk, they've identified, they've quantified, they've managed, and then the final step is to figure out how well we did. Look back and say, all right, this is our goal, and how well did we meet the goal? And so this is really important to evaluate the risk management system so that we can look at ourselves and say, hey, we deserve a high five for doing this and this and this, but we don't deserve a high five for doing this and this and this. And of course, we need to manage transaction costs, and we need to be aware of all the budget constraints. And so think about this process as being a cycle. We do all this stuff, then we completed the hedge, and then we have to look back and see how successful we were in implementing that hedge so that we can learn from it. Successful risk managers are not perfect. Successful risk managers are perfect in the sense that they learn from their prior mistakes. And sometimes it's impossible to be able to predict accurately the future path of prices. And so it's almost impossible to have perfect hedges no matter what those underlying assets are. But it's possible to get your arms around this process so that you can improve. I mean, look, I love to give sports analogies as well. I'm a basketball fan, I'm a football fan, I'm a golf fan. I mean, look at someone like Tiger Woods, who is recovering from back surgery and all kinds of other stuff. And you look at his swing these days, it looks better than ever. So he said, okay, I can't do this, I can't do that because I might break my back. So we look and we monitor the process and we make the changes. All right, so how do we do in this, in the last, what was this, 20 minutes or so? This is what our recap is. Yes, I think we've covered all of these learning objectives. Next up, we'll talk about some corporate governance issues.